assessment of macroeconomic conditions for the first 4 months of 2022 and its implications for the outlook for inflation and growth, provided the key considerations that the committee took into account in its decision on the stance of monetary policy. The committee noted that since the last MPC meeting in March 2022, global headwinds have intensified, underpinned by the spillover effects of the Russian-Ukraine war and China's zero-COVID policy. Particularly, the war has worsened pre-existing global supply chain disruptions, triggered food and energy price shocks, and further heightened uncertainty about global growth prospects. The quick turnaround from accommodative policies that characterized monetary policy conduct in advanced economies over the past 2 years and the slowdown in China's growth are expected to adversely impact the macroeconomic outlook for most emerging market and developing economies. The IMF, during the 2022 spring meetings, revised global growth forecasts downwards to 3.6% in 2022 from 6.1% in 2021. Global price pressures remain elevated, primarily due to escalating energy and commodity prices, as well as the persistent and broadened supply chain bottlenecks. As a result, headline inflation has not only breached the set targets across several advanced, emerging market and developing economies, but also reached record high levels not seen in several decades. These trends have prompted swift and coordinated monetary policy responses by major central banks. The U.S. Federal Open Market Committee and the Bank of England have all hiked interest rates and signaled further rate increases to address inflationary pressures, while the European Central Bank is expected to curtail the net asset purchase program by the third quarter. Similarly, policymakers in several emerging market and developing economies have moved towards policy tightening in response to rising inflation and currency pressures. The shift towards less accommodative monetary policy stances to contain inflationary pressures has resulted in tighter global financing conditions with negative spillover effects to emerging market and frontier economies. The strengthening of the US dollar and rising long-term bond yields have led to widened sovereign bond spreads and capital flow reversals, as well as currency pressures, especially for emerging market and developing economies with weaker fundamentals and less buffers. On the domestic front, data from the Ghana Statistical Service showed that the economy has rebounded strongly from the impact of the COVID-19 pandemic, stemming largely from all the policy measures that were put in place to forestall a recession. This is evidenced by the strong real GDP growth outturn of 5.4% reported for 2021, compared with 0.5% in 2020. Non-oil GDP grew at a stronger pace by 6.9% in 2021, significantly up from 1% in 2020. The strong pickup in economic activity was largely driven by the services and agricultural sectors. Information from the Bank of Ghana's updated Composite Index of Economic Activity shows that the observed strong growth momentum will likely persist in the first quarter of 2022. The CIEA recorded an annual growth of 4.6% in March 2022, compared to 4.2% and 4.4% in January and February, respectively. Available data show that exports are picking up. Credit to the private sector continues to recover, together with an uptick in industrial production. The improvement in domestic VAT suggests demand is picking up, and higher tourist arrivals were also recorded. These were the variables that drove the rise in the index. The pace of growth in broad money supply slowed in April 2022 on account of a contraction in net foreign assets of the banking sector, despite significant expansion in net domestic assets. Annual growth in broad money supply, M2+, moderated to 19.9% in April 2022 compared with 25.8% in the same period of 2021. In terms of components, the moderation in M2+ was reflected in currency outside banks, demand deposits, and savings and time deposits. Foreign currency deposits, however, recorded some growth over the review period. Annual growth in reserve money was 33.8% compared with 32% growth over the same comparative period last year. Credit to the private sector showed considerable improvement, almost back to pre-pandemic levels, and broadly in line with the uptrend in economic activities. In nominal terms, private sector recorded a significant annual growth of 26.5% in April 2022 compared with 6.9% in April 2021. In real terms, however, private sector credit grew by 2.3% due to sustained price pressures relative to a contraction of 1.5% recorded for the same comparative period. In terms of new advances, the data shows that credit growth continued to improve, reaching 16.4 billion Ghana cedis and representing a 56.5% year-on-year growth. The latest credit condition survey revealed that banks are, however, beginning to tighten credit stance on loans to enterprises and households. Despite the tightening of credit conditions, demand for credit by households and firms continues to remain strong. The latest confidence surveys conducted in April 2022 showed some easing of sentiments. Consumer confidence dipped on account of increases in fuel prices and transportation costs, as well as rising inflation. Business sentiments also dipped on concerns that price pressures and currency depreciation would adversely impact industry prospects. The survey findings were broadly aligned with observed trends in Ghana's Purchasing Managers Index, which reflected declines in both output and new orders. Developments in the banking sector indicated strong performance, despite the reversal of the COVID-19 regulatory relief measures in March 2022. Total assets rose to 194.3 billion at the end of April 2022, which represented 24.8% annual growth relative to 16.4% growth in the previous year. The growth was underscored by increased deposits and borrowings. Total deposits grew by 21.3% to 127.2 billion Ghana cedis, while borrowings recorded a strong growth of 66.2% to 25.9 billion Ghana cedis at the end of April 2022. The key financial soundness indicators remain strong, with the capital adequacy ratio at 21.3%, well above the regulatory minimum of 13%. Core liquid assets to short-term liabilities improved to 28.2% in April 2022 compared with 24.9% a year ago. The non-performing loan ratio eased to 14.3% at the end of April 2022 compared with 15.5% in the previous year, signaling some improvement in asset quality during the year. In the first 4 months of 2022, bank's profit before tax was 4.9 billion Ghana cedis, representing a 26.3% growth compared with 39.6% growth for the same period of last year. Net interest income grew by 12.2% to 4.6 billion compared to 18.4% growth a year ago. Net fees and commissions grew by 17.7% to 1.1 billion compared with 26.5% growth last year. Other income increased to 1 billion, representing 117.5% growth relative to the contraction of 7.9% last year. These developments resulted in a 22.1% jump in operating income to 6.7 billion compared with 16.8% growth in the corresponding period of 2021. Operating expenses recorded a 23% growth compared to 1.7% growth in the previous year. Recent price developments indicate elevated pressures arising from the sharp increase in global energy and commodity prices and the consequential effects on domestic export petroleum prices and transportation costs, food prices, as well as the pass-through effects of the recent exchange rate depreciation. The two inflation readings since the last MPC showed that headline inflation further surged from 15.7% in February 2022 to 19.2% in March and 23.6% in April. The price pressures are increasingly becoming broad-based and reflected in almost all the components of the consumer basket, from both domestic and imported sources. Non-food inflation went up significantly from 17% in March to 21.3% in April 2022, while food inflation also rose further from 22.4% to 26.6% over the same comparative period. At the same time, the bank's core inflation measure, which excludes energy and utility prices, picked up from 15.4% in February 2022 to 18.5% in March, and further up to 22.3% in April. On budget execution, provisional data for the first quarter of 2022 indicated an overall broad fiscal deficit of 2.6% of GDP against the program target of 2.3% of GDP. The corresponding primary balance for the period was a deficit of 2.3 billion Ghana cedis against a deficit target of 1.4 billion Ghana cedis. Over the period, total revenue and grants amounted to 16.7 billion Ghana cedis, below the projected 19.3 billion Ghana cedis. Total expenditures amounted to 27 billion Ghana cedis, below the program target of 30.5 billion Ghana cedis. The stock of public debt increased to 78% of GDP at the end of March 2022 compared with 76.6% of GDP at the end of December 2021. Of the total debt stock, domestic debt stock was 189.9 billion Ghana cedis, while the external debt was 201.9 billion Ghana cedis. Developments in the money market reflected upward trends across the entire spectrum of the yield curve, reinforced by the moderation in liquidity conditions in various market segments. From December 2021 to March 2022, the following was observed regarding movements in the rates. The 91-day and 182-day Treasury bill rates have increased to 16.22% and 16.72% respectively, from 12.49% and 13.19% respectively. The rate on the 364-day instrument also increased to 18.93% from 16.49%. Rates on the 2-year, 3-year, and 5-year bonds also went up. On the secondary market, rates on the 6-year, 7-year, 10-year, 15-year, and 20-year bonds all increased. The weighted average interbank rate increased to 16.4% from 13.57%, in line with the 250 basis points policy rate adjustment in March 2022. This has also transmitted to the retail end of the market, and average lending rates have inched up to 21.6% in April 2022 from 20.04% in December 2021. Commodity prices have remained volatile due to the ongoing geopolitical tensions. Average crude oil prices gained 42% on a year-to-date basis, to settle at $106.2 per barrel in April 2022, supported by supply constraints arising from the geopolitical tensions between Russia and Ukraine. Gold prices also gained 8.1% to settle at $1,935.89 per fine ounce, on the back of increased safe haven demand amid global inflation concerns. Similarly, cocoa prices went up by 4.4% to settle at $2,591.06 per ton in April 2022, compared to $2,481.95 per ton in December 2021, due to unfavorable weather conditions across West Africa. The favorable commodity price trends positively impacted the trade account as export inflows outweighed imports. Provisional data indicates a trade surplus of $1.3 billion in the first 4 months of the year, compared with a trade surplus of $778 million in the same period of last year. The improvement in export earnings was attributed to crude oil and non-traditional exports. Crude oil export receipts recorded a significant growth of 61% to $1.9 billion due to price effects, while gold exports improved by 3.6%, also supported by price effects. Non-traditional export receipts crossed the $1 billion mark in the review period and contributed significantly to the trade surplus. These developments outweighed the 7.7% growth in total oil imports in the review period, on the back of compressed non-oil imports. In total imports in the review period on the back of compressed non-oil imports. The trade surplus was offset by investment income outflows and net services payments, resulting in a current account deficit of $128.15 million for the first quarter of the year, representing a marginal improvement from the current account deficit of $197 million recorded in the first quarter of 2021. The capital and financial account, however, recorded some significant outflows from net portfolio reversals and net private capital outflows, which resulted in an overall balance of payments deficit of $934.46 million for the first quarter of 2022, compared with a deficit of $429.93 million same time last year. Gross international reserves at the end of April 2022 stood at $8.34 billion, equivalent to 3.7 months of import cover. This compares with $9.7 billion, equivalent to 4.3 months of import cover at the end of December 2021. In the foreign exchange market, the Ghana cedi depreciated by 15.6% against the US dollar, 13.1% against the pound sterling, and 13.6% against the euro during the quarter. From the beginning of April through 18th May 2022, there has been some moderation in the rate of depreciation. The cedi depreciated by 0.2% against the dollar, but appreciated by 5.7% against the pound sterling and 5.4% against the euro, bringing the year-to-date depreciation against these currencies to 15.8% against the US dollar, 8.2% against the pound sterling, and 8.9% against the euro. In sum, the committee observed that the global growth recovery is showing signs of a slowdown on account of heightened risk emanating from lingering supply chain bottlenecks, China's zero-COVID policy, and the Russia-Ukraine war. Concurrent with the growth slowdown is the sharp rise in inflation across several advanced and emerging market economies, which has posed some challenges to central banks globally. Global price pressures have broadened beyond the volatile items of energy and food. This has prompted some coordinated monetary policy tightening in advanced economies and most emerging market and developing economies, and triggered tightened global financing conditions. The spillover effects of these policy responses have impacted economies through the trade and finance channels, with vulnerable developing countries faced with capital flow reversals and currency pressures. Ghana's economy is already facing some of these headwinds from these spillover effects. Growth prospects in the domestic economy remain positive, and the bank's high-frequency indicators point to continued and increased momentum in economic activities, with private sector credit showing some improvement in real terms, despite the increased price pressures. All these are resulting in the closure of the negative output gap. The banking sector remains robust, with sustained growth in total assets, investments, and deposits. However, business and consumer confidence have dipped, reflecting the sharp depreciation of the currency and the general high inflationary environment, which has resulted in higher input costs for businesses. A quick turnaround with more confidence-building measures to counter these conditions would provide further boost to the real economy. On fiscal policy implementation, the committee observed that execution of the budget for the first quarter was broadly in line with targets, although there was a minor deviation in the deficit target, stemming largely from lower revenue receipts. It is the expectation of the committee that fiscal consolidation will take hold gradually, and the mid-year budget review will provide further fiscal fine-tuning to ensure that the fiscal consolidation efforts stay on track. Despite the improvement in the trade balance due to favorable commodity prices, the external sector has weakened somewhat due to developments in the capital and financial account. The domestic economy does not fully benefit from higher oil and gold prices due to retention agreements in these sectors. The increased repatriation from dividend payments and profits, as well as the net portfolio reversals, have resulted in a widened balance of payments outed and loss of reserves. The prevailing tight global financing conditions and further policy rate hikes in advanced economies continue to pose risks to the external outlook. Headline inflation surged in April 2022, and both headline and core inflation have stretched further above the upper limit of the bank's medium-term target band. The heightened uncertainty surrounding the inflation dynamics has weighed heavily on the domestic environment and significantly depressed business and consumer sentiments. The inflation numbers show that while food inflation has accounted for the increases in inflation over the past year, the recent jump in April shows that relative price increases in the non-food sector is accelerating at a fast pace, which provides information on the extent to which prices are becoming embedded. The bank's latest forecast shows a continued elevated inflation profile in the near term, with a prolonged horizon for inflation to return to the target band. Inflation expectations by consumers, businesses, and the banking sector have also heightened. The risks to inflation outlook are on the upside and emanate from the availability of inputs for food production, imported inflation, continued upward adjustments in export petroleum prices and transportation costs, possible increases in utility tariffs, and potential wage pressures. The second-round effects of these administered price adjustments would further amplify inflation pressures in the outlook. These considerations show that with a strong rebound in growth and the closing of the negative output gap, the balance of risk is clearly on inflation. The MPC took the view that it needed to decisively address the current inflationary pressures to re-anchor expectations and help foster macroeconomic stability. On the basis of the above assessment, the committee decided to raise the policy rate by 200 basis points to 19%.